Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show.
Hey, Jim. Thank you.
The pandemic had a lot of people pondering over whether they'd continue in the career they had before the pandemic hit. But also, during the pandemic, a lot of baby boomers decided to take retirement. What's that doing to our labor force?
Yeah, so it's, I think it really prompted, I think two things are at work there. One is that there was, as you know, the influx of government funds and support in extra payments to people that they weren't anticipating, and that boosted savings. So on the one hand, people had more cash savings than they'd had before. Asset owners, of course, have had this big boost in asset prices over the last year. So Canadians in particular are feeling more well off. Those that have homes or security portfolios are feeling like they're wealthier. Those things combined with the reality that there was a lot of risk and fear around working, for example, in the education sector, which was, very stressful with the opening and shutting and mask wearing and who knows how to contain this. And then also, if you look at the other places that primarily lost jobs were, of course, in hospitality, restaurants, retail, and then healthcare positions, frontline jobs, again, highly stressful positions. So if you're someone who's, later in your career and maybe within a couple or 3 or 4 years of when you thought you might be retiring, a lot of those people with that combination of factors decided to be preemptive and say, you know what, I'm going to retire now, and just avoid all the stress and strain around working in these pandemic conditions. So you have seen this, there is a lot of talk lately about the openings for jobs being at cycle highs and how there's not enough people filling or coming forward to apply for jobs in these frontline sectors. And I think that another factor at work there is the fact that childcare has continued to be a challenge for people with schools. Many schools didn't reopen into the end of the school year, and a lot of, I think, women in particular are sort of waiting until the fall in the hopes that kids will get back in school and they'll be able to resume employment, and hoping by then, of course, with the vaccination rates being up and the reopening happening, that things will be more normal and less stressful by the fall. So all those factors have really kept some people out of the workforce. And there's a lot of people running with the narrative that because of that, they think there's going to be this big wage spiral, runaway price in the cost of labor, and that's going to have push in terms of inflation into the consumer prices. I'm actually not very concerned about that being a lasting impact, because a couple of things. As I say, the benefits are not going to continue indefinitely. And for example, right now in the United States, there's no fourth stimulus check on the table. In fact, they're running up against another debt ceiling coming the end of July. So there's going to be, negotiations, as there always is, and some holdups around that. But there's no talk about getting more money into consumers' hands right now in terms of pandemic relief, so to speak, in the U.S. and in Canada. I think that's also the case. We now have 40% of the Canadian population is fully vaccinated, and about 77% is partially vaccinated. So I do think that there's going to be this expectation, at least, that people will return to work in the fall. If we get kids back in school, I think that's going to also bring more people out of summer holidays, so to speak, and back into the workforce. We've also had huge productivity enhancement in some sectors where businesses have figured out automation and technology, ways to continue to operate with a fraction of the staff. So some of those jobs are just not going to be available, or, there's not going to be need for workers for some of those positions. So you put all that together, and then I come to this last piece, which is that the baby boomer crowd who retired thinking, asset prices are up and I'm feeling wealthier and therefore I think I can retire now. I think they're going to have a period of reprisal again, just as they did in 2000 and in 2008. And I remember this vividly. There was a great exodus, for example, in 2000 of teachers taking, early retirement packages because they were either encouraged that their savings had gone up a lot and they could expect this to continue in the future in terms of stock market gains. And a good deal of them also were enticed to take lump sum packages out of their pensions and put it into the stock market thinking, hey, look, I'm richer than I think and I'm going to make even more money if I do this. And of course, what happens is the opposite tends to be the case. When you have these very, extreme highs in terms of valuation and pricing in asset markets, and people sort of pencil that in, and that's exactly what's happened in terms of expectations of return, but it's exactly counterintuitive because when you have these very high price levels, what you find is that the returns are much worse over the next decade than the prior decade. And so it's very likely, I think, that there's a good amount of people, just as there was after the 2002 bear market and the 07-09 bear market, where they say, oh wow, I don't have nearly as much money as I thought. My asset prices have come down considerably, and now I'm looking at having to go back to work. So I think that there's a good amount of boomers who maybe thought they could retire early who will reevaluate that as we get into the what I think is going to be a prolonged bear market. We're certainly overdue for that. A retest of these crazy prices that have come on the last year. If you couple that, Jim, with the fact that the Canadian housing market, again, it just needs to stop going up. It doesn't even need to go down. Just stopping going up, because we know that Canadians, for example, have been withdrawing a lot of funds to live, to pay for things, and to buy things like stocks in the stock market from their home equity. So while this is going up, again, this is an old theme we've seen many times before, when you get a highly, a fastly moving up housing market as we have had nationally and certainly in the hot spots in Canada in the last year, and then you get people banking on that continuing, so they use things like lines of credit, home equity withdrawals, margin debt, all kinds of indebtedness in order to continue to spend and also to think they're investing in these other things. So all you need is prices to stop going up on housing, and that would curtail the ability to continue taking these withdrawals. And I think, it's not likely that we're going to just have housing suspend for a decade here. I think we're probably going to see housing prices come down over the next few years, in which case that'll be even more pronounced in terms of squashing the ability to continue to extract funds and live on them. So all these factors, I think, are likely to alleviate this concern around the shortness of labor, and that's why I'm not concerned about that being an inflationary impact.
What about the people who are reconsidering their careers all the time they had at home, or reduced working hours to think about, maybe I don't want to be a waiter or waitress the rest of my life?
Well, I think they've had a profound sense of their vulnerability in terms of the availability of that work, and I wouldn't be surprised if people sort of try to figure out another path. The other thing, of course, is the incidence of working at home is pretty attractive, and a lot of studies have shown that even people who, ideally they'd like to work somewhere a couple or 3 days a week, but also from their home 2 or 3 days a week. And I think that the mass investment, this is the CapEx we've seen, that was accelerated by the pandemic in the last year, has meant that many businesses are now literally able to offer that kind of flexibility or homework to their workers. And so that is attractive to many people, that they could they could be much more efficient, potentially stable in terms of their income if they were able to do some work from home. So I think that's freeing up job opportunities, for example, in areas, geographical locations that are not necessarily coincident where head offices are. For example, like Metro Toronto, maybe prior to this, there was the bulk of the jobs were in metro cities, whereas now some of those positions are going to be possible for people to do from more remote locations. And so all of that makes it the reach of that employment wider, and therefore opens up the opportunity for people to consider alternate careers. And I think that that's part of this sort of pandemic's lasting impact on the labor force.
The Ontario engineering firm CF Crozier and Associates is offering employees $20,000 as a down payment on a home to help retain and recruit employees. Is that a trend of the future?
Yeah, well, this is if you're trying to attract talent, so to speak, the main concerns that they have, of course, is housing and how do they afford the roof over one's head in many of because as I was describing, the average home price in Canada, for example, is about $700,000 now nationally, just lunatic fringe, about 10 times the average or median household income in Canada. So it's really off the charts. So certainly there's a idea of how do we get employee loyalty and attract the type of qualified candidates that they need. So they're sort of saying, not only can we offer you flexibility of location in many of these jobs or working from home a certain amount of time, but here's a lump sum to help you. Because obviously saving lump sums after tax are pretty difficult for most people. So having that kind of incentive could be quite attractive. So I do think that is a smart way to try and go about it. However, I am still concerned that even people putting down a $20,000 down payment and or more, adding that to their down payment, are still at risk if they're taking on a lot of mortgage debt at these levels in order to get into the housing market. The downside is still that you could see a 20% drop that would completely evaporate any home equity they thought they had. And then we're back into this negative feedback loop of people not being able to afford as much as they thought before when prices were rising.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. One of the headlines on your blog, crypto scammers ripping off people for billions. What's the story there?
Yeah, that was a Bloomberg story, but there's been many of these cases documented in the last several months of people who the whole crypto craze, and it literally has been a craze. I've acknowledged before there's validity to the blockchain technology, and there may be some kind of a digital currency may end up becoming dominant, or various versions of it, perhaps stable coins, or the banks of different central banks will perhaps issue this tied to their currency or tied to deposits, some kind of backing. But really what we've got into in the last year has been this mania, which is that it's all been marketing and just basically ripe for fraud, because it's just someone declaring something, tweeting something, promoting something on social media, getting people to follow it, getting people to buy. This is all classic stuff, and it typically ends with them dumping as the new buyers come in a Ponzi type of environment, and the individuals get wiped out or realize that they've been taken. So it's just, again, a sign of the times. We've seen so much of that this cycle. It's really been something. I mean, it's not just the meme stocks, it's not just the big 5 tech stocks, which captured everyone's imagination in the last couple of years, and the SPACs, the shell companies that raise money just with the notion that they might buy something at some point. With all these things have been part of this mania that's really swept the world. And so as you look at it now, though, we see, for example, that the peaks in some of this is quite telling. So January we saw, for example, a peak in Tesla, which was one of the leading meme stocks that all these people were day trading in and out of. And then we saw again in February the SPACs really came off the boil. So this was another leg of this craze. And then in March we saw as everyone was expecting peak inflation and runaway inflation, we saw bond yields which had risen, meaning treasury prices had come off because of the expectation that rates were going to rise and inflation was getting out of control. But in fact, we saw at the end of March, treasury yields peaked. And in April, Bitcoin peaked, right? And it's down about 50% from where it peaked in April. In May, we saw the transportation sector. Again, there was a lot of, people so confident that transportation would only increase in terms of demand with the reopening trade, and that prices of transport were going to continue to rise. But in fact, we've seen a rollover in that sector since May. Financials peaked in about June, and now we're starting to see, things like lumber, peaked in about May as well. It's down 57%. Copper peaked in May. It's off about 10%. So I'm really starting to see a pattern here in terms of, we knew that it was unsustainable in the way that it was being driven by a lot of retail flows and people not doing any math and very little thinking and a lot of feeling. But also all these leading sectors that were at the head of the charge, so to speak, have now been coming off the boil. So we're seeing, in fact, that we used the opportunity of the sell-off in treasuries to add treasuries, and the Canadian 10-year yield, for example, was a high of 160 at the end of March, and today it's about 125. In the U.S. it was 173. Today it's about 130. And I think that, our central thesis has been that in the back half of 2021, we were going to see disappointment in terms of these unreasonable expectations about what the reopening trade would mean for spending. I've mentioned this before, but it can't be understated that we really did about 6 years of your typical durable goods spending in the economy over the last year. So these are items that last longer than 3 years, and people are up to the roof with things which they've primarily bought on credit. These are things they don't need another one of. They're not going to replace it soon. So that's really brought forward a lot of the expectation that people had of future consumption, and I think has already booked it as sales in the last year. And so what that leaves is this kind of hole. I mean, the economy basically was fully reopened in March, which I think lines up with this whole, the peak of expectations around growth and inflation was about March. And now we see that the reopening is, I think, going to deliver a lot less in terms of revenue than people were expecting. Because again, yes, we're shifting to services to some degree, but we also have this fall off in the need for durable goods spending. And of course, at the same time, we've still got all these other variants happening, right? Like the latest Delta variant, which is now leading another wave of outbreak in the United Kingdom, for example. They had 32,000 new cases just today, and the incidence of death and hospitalization is up 50% in the last 2 weeks. You're looking at a population where 65% of them have already had both shots, and you're still getting this big spike. And if you look at Canada, of course, for example, we've had 40%, as I mentioned, 2 shots, and in the U.S. it's about 58%. So I think this Delta is the dominant variant moving across the United States and Canada as well at this point. And so that, we're not out of the woods in terms of the potential for another shutdown phase or for more restrictions, this sort of concern. So I think we've really got ahead of ourselves, violently so in the first half of the year in 21, and that there's rife for disappointment. And that's why I think we're seeing things like the U.S. dollar strengthening in the last while, which has really taken people off guard. And I've described this many times as being such a key determinant, because when the U.S. dollar rises, the risk assets on the other end, which are commodities and cryptocurrencies and equities of all kinds, emerging markets, the whole 9 yards, all tends to sell off as the U.S. dollar strengthens. That's exactly what we're seeing. Is the same with treasuries. You know, treasuries are what is considered to be one of the few safe havens in this environment. So the risk trade all selling off, that means includes corporate debt credit, all starting to sell off, and you see inflows coming into things like treasuries. So I think it wouldn't be surprising to see that the treasury yields could continue to fall. In fact, we could see them, go back to a retest of where they were in the March 20 low, somewhere even below 1%, perhaps as low as 0.5%, which is where they bottomed out in March of 20. So that will really give a capital gains potential to government bonds in this environment, and for Canadians, further capital gains potential for the U.S. dollar versus the CAD, because again, we're the commodity-linked currency. So if commodities are coming off the boil and inflation expectations are going to prove disappointing for the people who are so confident that you'd only see this runaway inflation trade, I think that that's exactly what we're witnessing right now. So it has the potential to have legs. And I think the problem here is that everyone's been conditioned. Everyone, I'm talking about the newbies and those who have been recently participating in asset markets with no real rule set, with lots of leverage, lots of risk exposure. They've been rewarded for that in this environment up until recently, but I think that the problem is that they could be in for a hell of a trouncing when the trends reverse and prices start to fall. And they really have been conditioned to think of a bear market as something that lasts 3 weeks, when in fact, historically, a bear market is something that lasts multiple quarters, right? Potentially a couple of years. And we're really due for something like that. So I think that if we get an extended period here, you'll get the buy the dippers, of course, but if the dips continue to happen and you get a rise and then a lower low, that's really going to take people out in body bags in this environment, just because they're so unprepared. So those that have hedged their bets with some treasury exposure and some cash and some U.S. dollar, that kind of thing, you're much more likely to weather the storm, make some income, some capital gains, and then keep your liquidity for the potential for some extraordinary opportunities coming on the other side of this, which is really the good news story. But you have to be really pragmatic in the way that you approach it. Otherwise, you're in with the masses and you're likely to suffer the downside.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, we'll ask those questions for you if you send them to info@housestreet.com. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.